G'day and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us here at AusBiz. Well, let's check what happened overnight. Global stocks rallying, with investors buoyed by the US Federal Reserve's lowering of interest rates for the first time in more than 4 years. US investors embraced the likelihood of a soft landing for the economy, particularly after better than expected jobless claims data. The S&P 500 surging to a record high, while the Nasdaq bounced higher as well, and small cap Russell 2000 also surging. And the heavyweight tech stocks helped fuel the gains, led by Tesla, along with Nvidia, Apple and Meta. The S&P 500 Banks Index rose 2.5% as the Fed's rate cut eased credit risks, and gains in Citigroup and Bank of America after they lowered their prime rates. FedEx fell 10% in extended trade after the company cut its revenue targets for fiscal 25, whereas shares of sportswear company Nike jumped 8.5% after the bell, with the company's chief executive announcing his retirement. Fertility benefits firm Progyny plunged after a significant client notified the company it had elected to exercise a 90-day option to terminate its services agreement. And US-listed shares of BHP and Rio rallied as Morgan Stanley said a seasonal restock would bring the metals and mining sector back into focus. Well, the number of Americans filing new jobless claims dropped to a 4-month low last week, underscoring solid jobs growth while supporting the notion of a soft landing for the US economy. Initial claims came in below consensus at 219,000. Meanwhile, existing home sales in August fell 2.5%, which was much more than expected, and the Conference Board leading index fell 0.2%. Well, the jobless data helped push US Treasury yields higher, with the 10-year at 3.76% and the 2-year at 3.6%. And in the wake of the Fed's 0.5 percentage point rate cut, the Bank of America Global Research Team has raised its forecast for a total of 75 basis points of easing this year. Elsewhere, the Bank of England, it left its policy rate unchanged overnight at 5%, as expected, with Governor Andrew Bailey saying it should be able to reduce rates gradually over time. UK inflation is forecast to be at 2.5% at the end of this year. And Norway's central bank also left its policy rate unchanged at 4.5%. Well, the US dollar has slipped in choppy trade, although it's strengthened against the yen ahead of the Bank of Japan policy meeting today, where it is expected to keep rates on hold. And the Aussie has risen to 68.1 US cents. Okay, so let's get further reaction, certainly what we saw on markets overnight in response to that Fed move the day before. Brad Gasworth joining us from Unearthing Opportunities. Brad, very good to catch up with you again. Thanks for joining us. Well, it took a while because it was interesting. Immediately after that announcement by the Fed, investors thought it's good. No, maybe it's not good. But now they're obviously seeing the positive side.
Yeah, Andrew, absolutely. It was a little bit of a tug of war at first. And you and I spoke about this a couple of weeks ago. Would we get a 50 basis point cut, or would we see that 25? And, I think a lot of people were shocked that we got 50 off the bat. I think it shows the aggressiveness of this cut period. And, it took some time to really digest it, but clearly, the markets liked it and it was well received today.
So, Brad, how are you viewing the equity market at the moment then, with the prospect of perhaps investors seeing a soft landing? Nonetheless, clearly the Fed's seeing some issues with the economy in terms of it slowing down. Is that likely to drag on earnings going forward? If so, how's that likely to play out on the equity market, do you think?
Yeah, great questions here, Andrew. And I think this is, first, it's too early to say we'll get a soft landing. There's a lot of places and pieces to the puzzle to see if that actually transcribes. But in terms of equities and fundamentals, I think you're going to see continued great fundamentals from across the board, across asset classes and sectors. I think when you look at lower rates, that's going to be positive for the capital side for companies. I think what you're seeing from AI and the technology increases in efficiencies, that's also very good for fundamentals. So this is just fuel to the fire of being, people who are bullish like myself for equity markets. I think this is definitely another reason to be positive into the equities at this current juncture.
Okay, Brad, so you're very much a believer in AI there. So I note that you're looking to perhaps diversify your assets across those with exposure to AI. How are you doing that?
Yeah, I mean, if you're looking at the large cap, I mean, I still think the large cap stocks will continue to lead the race in equities, and you saw that with that rebound today. I think you're going to see the likes of Nvidia, Google, or Alphabet, Adobe, Salesforce.com. I think these are all, and Amazon. All of these large cap or mega cap stocks are going to perform quite well during this period. At least on the financials, are continue to be up into the right. Now, I think you're going to see some interesting pulls and takes in the market on the retail sector. I think you're seeing a big bifurcation of rich and poor, and I think you're going to see that gap widening over the next several years. So I think high-end retailers should benefit, and I think the low end as well. I think what you're seeing on the middle class is the thing to worry about, especially in the next several years. But in terms of the overall market, I still see positive trends throughout into the end of this year, into next year.
You're talking about the retailers there. So what in particular companies like Target or Walmart, do you think they're facing those headwinds at the moment?
Yeah, well, and these are great questions here, Andrew. I think if you look at those retailers in particular, I think you have a few different crosswinds. One, on the unemployment side, we did get a little bit better numbers recently, but don't forget that the Bureau of Labor Statistics just revised that last one down 1 million. So, can we trust this recent number or not, or will that one be revised lower as well? But ultimately, like in the likes of a Walmart or Target, I think you're seeing a shift from where the middle class was shopping to a little bit lower demographic, and I think that's going to benefit those retailers. Now, I think Amazon's a big winner overall because just with the ease of Prime and what they've done on the retail space, I mean, they're a juggernaut, and it's hard to really compete with. Walmart and Target are doing a good job. I expect a shift towards the lower side, and those retailers should benefit.
Brad, just returning to those tech stocks, a couple in focus there. Of course, Apple recently launching its iPhone 16. The company is trying to integrate those AI features. How are you seeing where Apple's placed at the moment?
Yeah, and I mean, it's a great question here, Andrew, because there's a lot of focus on the new iPhone and the lack of upgrades for it. It's very much just a little bit of an enhanced 15. But that being said, they have such a large install base that Apple will benefit from an upgrade cycle. Now, is the 16 that impressive to go ahead if you have a 14 or 15 to upgrade right now? The answer is no. I mean, it's really not that impressive. However, again, because their install base is so large, you're going to continue to see the company benefit from it. Now, looking at some of those new product upgrades, everything was just an incremental benefit. It wasn't anything significant. The thing that worries me with Apple now, the company does generate significant cash flow, and that's a real reason to be super positive on the company. The risk that I'm worried about is their China exposure. They do have a decent China exposure, and there's more risk with that country shutting off iPhone sales than and more of a positive risk. So to me, I think the risk reward is not right there right now. I'd much rather be invested and have overweight exposure to an Alphabet or an Amazon over an Apple.
Brad, that risk on sentiment certainly benefiting crypto. We saw those crypto-orientated companies getting a big boost overnight. Is that sector interesting you at all at the moment?
And it's another good question here, Andrew. I still have the belief that we still have a better entry point for cryptocurrencies. It's been that whole space has been incredibly volatile. I'd much rather be in safer asset classes, especially in commodities, if I look at gold or silver, and those have been playing out very well. I mean, I feel like I'm a broken box speaking about my bullish thesis on both of those precious metals, but they continue to hit new highs. And when I look at, owning a gold or silver compared to a crypto, the risk averse nature, I think it's a lot better to have that precious metal exposure. That being said, there'll be a time to look into and be more aggressive on the crypto side. I'm personally just not there yet.
So just picking up then on your thoughts on precious metals, in particular gold, given we've seen it's taken out new records again, what do you think is likely to be the catalyst driving it higher from here? Obviously, we see the benefit there as interest rates fall, given it's non-yield bearing. But We've also got those geopolitical tensions playing out. We've had central bank buying. Is that likely to continue, do you think?
Yeah, and I think you just answered that question, Andrew. I think both of those reasons are the reasons why it makes sense to have exposure. There's many others as well. I think it's one of the safer asset classes. It's a tangible good. It's a tangible precious metal that it has value across the world. Now, if we do have more macro concerns or geopolitical risk or other things that are happening on the macro side, I mean, the safe haven is gold. And then even if we do have this positive, markets, which I'm expecting to have, positive trends for the markets throughout the rest of this year, I still think gold is going to benefit. I think you're seeing, the need for more diversification outside of a singular asset class. I think there's probably a lower exposure in that commodity, and I think you're going to see a shift and more diversification, and that would include gold. So I still like it for several reasons. I think you made it easy and answered the question at the beginning, but there's many reasons to be positive on gold, and I don't think that new highs is going to. I think we'll continue to see new highs over the next several years.
Brad, thanks for joining us on Unearthing Opportunities.
Thank you, Andrew.
Let's turn our attention to what we're likely to and we'll see this morning there. As you can see, SPI futures up almost 0.4%. So we did hit another record high on the ASX 200 yesterday. So looking to extend those gains today. So stay with us as we head towards the open in just a couple of minutes.